Hey everyone! Welcome back to our channel. Today, we're diving into the fascinating world of Bitcoin and its profound implications on economics and computer science. Strap in because we're about to embark on a journey through the revolutionary invention that has forever changed how we transfer value across the globe. In 2008, the mysterious Satoshi Nakamoto published a groundbreaking 9-page solution to the Byzantine general's problem. Nakamoto's creation, Bitcoin, allowed for the first ever trustless transfer of value over vast distances. This paradigm shift was so significant that Nakamoto could be considered for a Nobel Prize in Economics and the Turing Award. Now, let's talk about Bitcoin from an investment perspective. At its core, Bitcoin introduced a new scarce digital asset, Bitcoins. These digital tokens are created through a process known as mining. Think of it like digital gold mining, following a predictable production schedule. By design, only 21 million Bitcoins will ever exist, and we're already at approximately 16.8 million mined. But what gives Bitcoins value? They're not backed by physical commodities or guaranteed by governments or companies. Instead, Bitcoins fall into the category of monetary goods, with their value determined gain theoretically. In other words, the value comes from each market participant's appraisal of what others will value. To truly grasp this concept, we must delve into the origins of money itself. That's it for today's video, folks. If you're interested in learning more about Bitcoin, cryptocurrencies, and the future of digital currency, head to our website, cryptoinvestornewsnetwork.com. Not only will you find the latest news and updates, but you can also browse our crypto merchandise and even purchase a Ledger hardware wallet to secure your digital assets. The links are in the description below. If you enjoyed this video, please give it a thumbs up, leave a comment, and share it with your friends. Remember to follow us on Twitter at CINN Crypto News for the latest updates and discussions. Thank you so much for tuning in. As always, we appreciate your support and we'll see you in the following video. Remember to subscribe to our channel for more insightful content on cryptocurrencies and the ever-evolving world of digital finance. Hey everyone! Welcome back to our channel. In today's video, we will demystify the Byzantine general's problem and how Bitcoin provided a groundbreaking solution to this long-standing conundrum. Let's dive right in. The Byzantine general's problem is a classic dilemma in computer science and distributed systems. It revolves around achieving consensus among multiple parties or nodes that may be separated by distance, has limited communication, and even face potential deception from rogue nodes. Imagine a group of Byzantine generals laying siege to a city. They must decide whether to attack or retreat and reach an agreement to ensure success. However, they can only communicate through messengers. Some generals might be traitors, providing false information. The challenge is to find a way to achieve consensus despite these obstacles. Enter Bitcoin. Satoshi Nakamoto, the elusive creator of Bitcoin, introduced the world to the blockchain. This decentralized and transparent system enabled trustless value transfer. By utilizing cryptographic proof and a consensus algorithm called proof of work, Bitcoin effectively solved the Byzantine general's problem. The blockchain's decentralized nature ensures no single party can control the network. At the same time, the transparency of transactions and the mining process make it virtually impossible for bad actors to manipulate the system. This groundbreaking solution paved the way for countless innovations in digital currency and decentralized finance. And that wraps up our explanation of the Byzantine general's problem and how Bitcoin solved it. Before you go, check out our website, cryptoinvestornewsnetwork.com, for the latest news, updates, and resources on cryptocurrencies and blockchain technology. Remember to visit our online shop for excellent crypto merchandise and even purchase a Ledger hardware wallet to secure your digital assets. You can find the links in the description below. If you found this video helpful, please give it a thumbs up, leave a comment, and share it with your friends. We'd love to hear your thoughts. And follow us on Twitter at CINN Crypto News for real-time updates and discussions. Thank you so much for watching, and as always, we appreciate your support. Hit that subscribe button to stay informed about the ever-evolving world of digital finance. Join us for our next video. See you next time. Hey everyone, and welcome back to our channel. Today, we will take a fascinating journey through the origins of money, from the earliest barter systems to the modern age of digital currencies. Grab your favorite beverage, and let's get started. In the beginning, trade between groups of people was based on barter. But barter had limitations, including the infamous double coincidence of wants problem. Over time, humans evolved a desire for collectibles like shells, animal teeth, and flint, which served as a proto-money. They enabled trade between tribes and wealth transfer across generations. As Nick Szabo explains in his essay on the origins of money, these collectibles provided early humans with a distinct evolutionary advantage. These collectibles or heirlooms were rarely exchanged, serving primarily as a store of value rather than a medium of exchange. The game-theoretic dilemma faced by early humans was determining which objects would be desired by others. Those anticipating future demand for certain collectibles gained significant trade and wealth accumulation advantages. This feedback loop, a Nash equilibrium, drove societies to converge on a single store of value, promoting trade and paving the way for civilization. Throughout history, as trade routes developed and societies expanded, different stores of value competed against each other. Merchants played a crucial role in promoting the adoption of foreign stores of value, which led to increased trade and wealth. The 19th century saw the world converging on gold as the dominant store of value, resulting in an unprecedented explosion of global trade. And now, in the digital age, we have witnessed the rise of Bitcoin and other cryptocurrencies, offering a new way to transfer value and store wealth. These digital currencies stand as the latest chapter in money's long and fascinating history. That's it for today's journey through the origins of money. If you'd like to explore more about cryptocurrencies and the world of digital finance, visit our website at cryptoinvestornewsnetwork.com. You can also check out our online shop for cool crypto merch and purchase a Ledger hardware wallet to secure your digital assets. The links are in the description below. If you enjoyed this video, please give it a thumbs up, leave a comment, and share it with your friends. We'd love to hear your thoughts on the evolution of money. Remember to follow us on Twitter at CINN Crypto News for real-time updates and discussions. Thank you for tuning in, and as always, we appreciate your support. Hit the subscribe button to stay informed about the world of cryptocurrencies, and join us for our next video. Until then, happy trading! Hey everyone, welcome back to our channel. Today, we're diving into the attributes of a good store of value and comparing three significant contenders: Bitcoin, gold, and fiat money. By understanding these attributes, you'll be better equipped to decide which asset is best for your investment strategy. So, let's break down each store of value based on its durability, portability, fungibility, verifiability, divisibility, scarcity, established history, and censorship resistance. 1. Durability. Gold takes the crown here due to its ability to withstand the test of time. Fiat currencies depend on the durability of the institutions that issue them, which can be fleeting. While still relatively new, Bitcoin has shown resilience in its network and will be considered durable as long as the network remains functional. 2. Portability. Bitcoin is the clear winner, with private keys easily stored and transmitted digitally. Fiat currencies are portable, but government regulations and capital controls can hinder large transfers. Being dense and physical, gold is the least portable of the three. 3. Fungibility. Gold sets the standard for fungibility, as 1 ounce is virtually indistinguishable from another. Fiat currencies are generally fungible, but government intervention can create discrepancies. Bitcoin is fungible at the network level, but its traceability on the blockchain could lead to issues with tainted coins. 4. Verifiability. Bitcoin allows for mathematical certainty when verifying ownership through cryptographic signatures. Fiat currencies and gold can be verified, but counterfeiting remains a concern. 5. Divisibility. Bitcoin excels with its ability to be divided down to 100 millionth of a coin. Fiat is divisible enough for practical use, while gold can be cumbersome when divided into small quantities for everyday transactions. 6. Scarcity. Bitcoin's predetermined 21 million coin cap ensures its scarcity. Gold's supply could increase with new mining methods, and fiat currencies are historically prone to inflation and increased supply. 7. Established history. Gold boasts the longest and most storied history as a store of value. Fiat currencies are a recent anomaly with a track record of eventually losing value. Bitcoin is still young, but its continued existence increases society's confidence in its longevity. 8. Censorship resistance. Bitcoin shines with its permissionless, distributed nature, making it challenging to regulate. Fiat currencies are subject to state control, and gold is more susceptible to regulation due to its physical form. In conclusion, Bitcoin excels across most attributes, making it a powerful contender as a store of value. Its combination of censorship resistance and absolute scarcity is particularly attractive to investors looking to safeguard their wealth. Before you go, check out CryptoInvestorNewsNetwork.com for the latest news, analysis, and insights on everything crypto. And remember our shop for crypto merch and Ledger hardware wallets. Links are in the description below. Please like, comment, share, and subscribe if you found this video helpful. Also, follow us on Twitter at CINN Crypto News for updates. Thanks for watching, and we'll see you in the following video. Hey everyone! Today, we'll discuss the fascinating evolution of money, from its early days as collectibles to modern cryptocurrencies like Bitcoin. We'll also touch on the various stages a monetary good goes through as it becomes widely adopted. Money has continuously evolved in stages, with the store of value role preceding the medium of exchange role. The 4 stages of monetization are: 1. Collectible. 2. Store of value. 3. Medium of exchange. 4. Unit of account. During monetization, a monetary good's purchasing power will rise, often creating the appearance of a bubble. This monetary premium can be volatile, as the good might face competition from other forms of money or external factors such as government intervention. The path toward monetization is also highly dependent on the decisions of market participants, who attempt to anticipate future demand and monetary premiums. This path dependence can cause confusion in understanding the price movements of monetary goods. Additionally, market participants don't just act as observers but as active evangelizers, promoting the benefits of their preferred form of money. This can lead to a fervent, almost religious dedication to a specific monetary good, which we can see with Bitcoin enthusiasts. As we witness Bitcoin's transition from an incipient store of value to a potential medium of exchange, it's essential to understand the complex and interconnected factors that influence its adoption and valuation. If you're interested in learning more about cryptocurrencies and the world of investing, visit CryptoInvestorNewsNetwork.com for the latest news, analysis, and insights. And remember to check out our shop, where you can find crypto merch and even purchase a Ledger hardware wallet. Links are in the description below. If you found this video helpful, please like, comment, and share, and remember to subscribe. Also, follow us on Twitter at CINN Crypto News for updates. Thank you for watching, and we'll see you in the following video. Hey everyone! Today, we will discuss the fascinating shape of monetization, particularly in the context of cryptocurrencies like Bitcoin. We'll examine how Bitcoin's price appears to follow a fractal pattern of increasing magnitude, resembling the classic Gartner hype cycle. The Gartner hype cycle consists of several phases. 1. Innovation trigger. 2. The peak of inflated expectations. 3. Trough of disillusionment. 4. Slope of enlightenment. 5. Plateau of productivity. Each cycle starts with enthusiasm for the new technology, followed by a peak as speculators jump in to make quick profits. After the peak, prices drop, despair sets in, and the technology is widely derided. However, a plateau eventually forms, where a new cohort of believers joins early adopters with firm conviction. This plateau creates a stable, boring low during which public interest dwindles. Still, development continues, and the number of strong believers slowly grows. This sets the stage for the next hype cycle, which attracts a larger set of adopters and reaches greater magnitudes. Gold followed a similar pattern from the late 1970s to the early 2000s, suggesting monetization's hype cycle may be an inherent social dynamic. Understanding these cycles can help us make sense of the roller coaster ride of cryptocurrency adoption and the market's reaction to new and transformative technologies. To learn more about cryptocurrencies and investing, visit cryptoinvestornewsnetwork.com for the latest news, insights, and analysis. Also, check out our shop for crypto merch and the opportunity to buy a Ledger hardware wallet. Links are in the description below. If you found this video helpful, please like, comment, and share, and remember to subscribe to our channel. Follow us on Twitter at CINN Crypto News for updates and more content like this. Thanks for watching, and we'll see you in the following video. Unraveling Bitcoin's Gartner hype cycles, understanding the investor cohorts. Hey everyone, welcome back to our channel. Today, we'll be taking a deep dive into the world of Bitcoin and its fascinating journey through 4 major Gartner hype cycles since its inception in 2010. We'll also identify the cohorts of investors associated with each cycle and how they influence the market. The first hype cycle, ranging from $0 to $1 between 2009 and March 2011, was dominated by cryptographers, computer scientists, and cypherpunks. These early adopters recognized the potential of Satoshi Nakamoto's groundbreaking invention. They ensured that the Bitcoin protocol was free of technical flaws. The second cycle, from $1 to $30 between March and July 2011, attracted tech enthusiasts and ideologically motivated investors. Libertarians, such as Roger Ver, saw the potential of a stateless currency. At the same time, serial entrepreneurs like Wences Casares evangelized Bitcoin to Silicon Valley's elite. The third hype cycle, from $250 to $1,100 between April and December 2013, witnessed the entrance of early retail and institutional investors. The market continued to grow despite the challenges of purchasing Bitcoins through the infamously ill-fated Mt. Gox exchange. After the collapse of Mt. Gox and a 2-year lull, the fourth hype cycle began in 2016. This cycle, with prices ranging from $1,100 to $19,600, has been dominated by the early majority of retail and institutional investors. As liquidity deepens and matures, institutional investors have entered the market through regulated futures markets, paving the way for a potential Bitcoin ETF. Although we can't predict the exact peak of the current hype cycle, it's reasonable to assume that it could reach between $20,000 and $50,000. Beyond that, Bitcoin would command a significant fraction of gold's entire market capitalization, which may still need to be achievable. And that's it for today's video. If you want to stay updated on cryptocurrencies, visit our website at cryptoinvestornewsnetwork.com. Remember to check out our shop for some awesome crypto merch. You can buy a Ledger hardware wallet through the links below if you need a secure way to store your digital assets. Please give this video a thumbs up, leave a comment with your thoughts, and share it with your friends. Remember to follow us on Twitter at CINN Crypto News for the latest updates. Thanks for watching, and see you in the following video. Bitcoin and nation-states, the struggle for control and the future of global reserve currencies. Hey everyone, welcome back to our channel. In today's video, we'll discuss the role of nation-states in the future of Bitcoin and how this digital currency could become a part of their foreign currency reserves. As Bitcoin's market capitalization approaches the $1 trillion mark, it becomes more attractive and liquid for nation-states to consider adding it to their reserves. The entrance of the first state to officially do so could trigger a domino effect, with others rushing to follow suit. Early adopters would see the most significant benefits if Bitcoin became a global reserve currency. Ironically, countries with strong executive powers, such as dictatorship like North Korea, might move the fastest in accumulating Bitcoins. Meanwhile, Western democracies with weaker executive branches may lag. The US, currently one of the most open in its regulatory stance towards Bitcoin, risks losing its dominant position if Bitcoin supplants the dollar as the world's reserve currency. Interestingly, Russia and China have been hostile towards Bitcoin, focusing on its potential impact on their internal markets. However, just like Charles de Gaulle in the 1960s, they may eventually realize the geostrategic benefits of Bitcoin as a reserve currency. With its vast Bitcoin mining capabilities, China already has a distinct advantage in accumulating Bitcoins for its reserves. As the banking industry and the U.S. Federal Reserve recognize the existential threat Bitcoin poses to U.S. monetary policy, a struggle will emerge between Silicon Valley innovators, who aim to keep Bitcoin free of state control, and central banks and the banking industry, who will attempt to regulate Bitcoin to preserve their power. Before we wrap up, remember to visit our website, cryptoinvestornewsnetwork.com, for the latest cryptocurrency news and insights. You can also check out our shop for awesome crypto merch, and if you're looking for a secure way to store your digital assets, consider purchasing a Ledger hardware wallet through the links in the description below. If you enjoyed this video, please give it a thumbs up, comment with your thoughts, and share it with your friends. Remember to follow us on Twitter at CINN Crypto News for more updates. Thanks for watching, and see you in the following video. Hyper-Bitcoinization, the transition from store of value to medium of exchange. Hey everyone, and welcome back to our channel. Today, we're diving into the fascinating concept of hyper-Bitcoinization and how Bitcoin could transition from a store of value to a widely accepted medium of exchange. For a monetary good to become a medium of exchange, it must first be widely valued. With its rapidly appreciating purchasing power, a store of value like Bitcoin can be used as a medium of exchange in specific situations, such as the illicit drug market, where the risk of using fiat currency is high. However, there are significant institutional barriers to overcome in a developed society. States use taxation as a powerful tool to protect their sovereign money from being displaced by competing monetary goods like Bitcoin. This taxation creates friction when using a store of value as a medium of exchange. Despite these challenges, if faith in a sovereign money collapses and hyperinflation occurs, the value of that money plummets against more liquid goods or even tangible assets. In extreme cases, society may devolve to barter or completely replace the failing currency with a new medium of exchange, such as Bitcoin. Bitcoin's borderless nature and the absence of a need for a banking system make it an ideal alternative for those affected by hyperinflation. As more fiat currencies follow their historical trend toward worthlessness, Bitcoin will become an increasingly popular choice for global savings. When a nation's currency is abandoned and replaced by Bitcoin, it will have transitioned from a store of value to a generally accepted medium of exchange. This process is known as hyper-Bitcoinization. Before we wrap up, remember to check out our website, cryptoinvestornewsnetwork.com, for the latest news and updates on cryptocurrencies. You can also browse our shop for cool crypto merch and consider purchasing a Ledger hardware wallet through the links in the description below to store your digital assets securely. If you enjoyed this video, please hit that like button, share your thoughts in the comments, and share this video with your friends. Be sure to follow us on Twitter at CINN Crypto News for more updates. Thanks for watching, and we'll see you in the following video. Debunking common Bitcoin misconceptions and understanding the real risks. Hey everyone, welcome back to our channel. Today, we will address some of the most commonly held misconceptions about Bitcoin and discuss the risks you should know before investing. So, let's dive right in. First, let's tackle the misconception that Bitcoin is a bubble. While it's true that Bitcoin displays a monetary premium, this is a defining characteristic of all monies. As Bitcoin continues to be adopted and its market capitalization grows, its volatility will decrease, making it more suitable as a widely used medium of exchange. Another common criticism is that Bitcoin's transaction fees are too high. But the truth is, high fees indicate a secure network, and as Bitcoin matures, most transactions will take place on second-layer networks like the Lightning Network, which will offer lower fees. Discuss the concern that competition from other cryptocurrencies might threaten Bitcoin's dominance. While it's true that many alternative coins have emerged, they have yet to manage to match Bitcoin's network effect, which encompasses its liquidity, user base, and developer community. This network effect is a crucial feature that differentiates Bitcoin from its competitors. Regarding forks, like the creation of Bitcoin Cash, it's important to remember that most market capitalization will settle on the network with the most active and skilled developer community. This has been the case with previous forks, and Bitcoin continues to attract the best talent in the field. With these misconceptions out of the way, let's briefly discuss the risks you should consider when investing in Bitcoin. Protocol risk, exchange shutdowns, and fungibility. While these risks exist, they still need to negate the potential of Bitcoin as a transformative technology and investment opportunity. That's it for today's video. To stay updated with the latest cryptocurrency news and insights, visit our website, cryptoinvestornewsnetwork.com. And remember to check out our shop for awesome crypto merch and our Ledger hardware wallet affiliate link in the description below. If you enjoyed this video, please like it, comment, and share it with your friends. Also, remember to follow us on Twitter at CINN Crypto News for more updates. Thanks for watching, and see you in the following video. Bitcoin's journey, from collectible to global money and its impact on the world. Hey everyone, welcome back to our channel. Today, we're diving into the exciting world of Bitcoin and its potential to become global money, just like gold during the 19th century classical gold standard. From its creation by the mysterious Satoshi Nakamoto to its present-day value, we'll explore why Bitcoin is massively undervalued and how its rise could have profound geopolitical consequences. So, make sure you stick around till the end. As a non-sovereign monetary good, Bitcoin has the potential to transform from a collectible to a store of value and, eventually, a global currency. This bullish case for Bitcoin was made by its creator, Satoshi Nakamoto, as early as 2010 and later reinforced by cryptographer Hal Finney. They envisioned a world where Bitcoin could dominate the global payment system, assigning each coin a value of about $10 million. Even if Bitcoin doesn't achieve full global money status, it can still compete with gold as a non-sovereign store of value. Currently, Bitcoin is superior to gold in every aspect except established history. Still, as time goes on, this advantage will diminish. If Bitcoin approaches or surpasses gold's market capitalization in the next decade, it could reach a value of around $380,000 per Bitcoin. However, for this to happen, some participation by nation-states is necessary. While it's unclear whether Western democracies will join the Bitcoin market, it's more likely that smaller nations and dictatorship will be the first to embrace this new currency. Even without nation-state participation, Bitcoin still has a bullish case as a non-sovereign store of value for retail and institutional investors. The increased investment makes a price between $100,000 and $200,000 feasible. Bitcoin's rise as a global currency will have significant geopolitical implications. It will force nation-states to shift their funding from inflation to direct taxation and, consequently, reduce the size of governments. As Charles de Gaulle hoped, global trade would be settled on an equal monetary base. In conclusion, Bitcoin's journey from a collectible to global money holds the potential to reshape the world's economy and geopolitical landscape. It's an exciting time to be involved in the world of cryptocurrencies. To stay updated on the latest crypto news and investment opportunities, check out our website, cryptoinvestornewsnetwork.com, and browse our fantastic selection of crypto merch. Remember, you can also buy a Ledger hardware wallet using the links in the description below. If you enjoyed this video, please give it a like, share it with your friends, and leave a comment below. Remember to follow us on Twitter at CINN Crypto News for more updates. As always, thanks for watching, and see you in the following video. Bitcoin mining energy debate, unveiling the unseen costs and benefits. Hey everyone, welcome back to the Crypto Investor News Network. Today, we will address a hotly debated topic in cryptocurrency: the energy consumption of Bitcoin mining. Mainstream opinion writers have expressed concerns about the energy-intensive nature of Bitcoin mining, suggesting that it contributes to climate change and is a potentially catastrophic energy guzzler. But is this the whole story? Let's dive in and explore some unseen costs and benefits that must be considered in this debate. Now, critics of gold made similar arguments decades ago, claiming that a fiat or paper money standard was more economical than gold. However, in his work, The Costs of a Gold Standard, Roger Garrison pointed out that comparing the resource costs of gold to those of paper doesn't settle the issue. Garrison identified additional costs society incurs under a paper standard, such as the costs imposed by political factions and special interest groups, inflation-induced misallocations of resources, and costs incurred by business people in their attempts to predict future monetary authority actions. Bitcoin's energy-intensive computing is necessary for its social scalability. According to Nick Szabo in his piece, Money, Blockchains, and Social Scalability, the high resource consumption of Bitcoin provides more vigorous resistance to forgery, inflation, and theft due to the difficulty of production and the easy-to-verify nature of proof-of-work schemes. When comparing monetary standards, it's essential to consider other costs society bears under government fiat money and the resulting inflation. These costs include financing destructive programs like the warfare and welfare state, which would otherwise require increased direct taxation. Could a similar argument be applied to gold or other cryptocurrencies? Possibly, but it's essential to recognize the risks of gold centralization, confiscation, and government co-opting. As for other cryptocurrencies, Carl Menger's On the Origins of Money suggests a tendency towards one highly liquid and saleable money, so speculating on gold or another cryptocurrency would require the belief that it could win in the marketplace for cash. The future is uncertain, and we don't know if Bitcoin or other cryptos will win the global market for the money. However, should a Bitcoin standard emerge, a holistic consideration of its mining costs and unseen benefits would include a dramatic restriction in government size, the end of the fractional reserve banking-induced boom and bust cycle, and a reduction in the welfare and warfare state. As Garrison writes, the opportunity cost is the only cost that counts. That's it for today's video. If you're interested in learning more about the world of cryptocurrency and staying up to date with the latest news, visit our website, cryptoinvestornewsnetwork.com. Remember to check out our shop for some awesome crypto merch, and if you're in the market for a Ledger hardware wallet, the links are in the description below. Please like, comment, and share this video, and remember to follow us on Twitter at CINN. Until next time, happy investing! Why Bitcoin's energy consumption is a game changer. Hey there, fellow crypto enthusiasts. Welcome back to Crypto Investor News Network, the ultimate source for everything crypto. Today, we're going to delve into why Bitcoin's energy consumption and proof of work, POW, are not only efficient but also game changers for our society. But before we dive in, don't forget to hit that like button, leave a comment, and share this video. Also, follow us on Twitter at CINN Crypto News for all the latest updates. Let's get started. There's a common misconception that Bitcoin's proof of work is wasteful and environmentally harmful. But did the energy required to power Bitcoin significantly improve our standard of living and advance our civilization? First, let's talk about energy and work. The concept of work being energy began with French mathematician Gaspard Gustave de Coriolis. Since then, we've been harnessing the power to improve our lives, from using fire and domesticating animals, to building great machines that run on various energy sources. Money itself is a form of stored energy. In fact, industry leaders like Henry Ford and Thomas Edison were once interested in creating an energy-based currency. However, it wasn't possible back then because energy couldn't be transmitted or stored easily. Fast forward to 2008, when Satoshi Nakamoto introduced Bitcoin and its revolutionary proof-of-work (POW) system. POW uses energy-consuming machines called ASICs to mine Bitcoin, thus converting energy into digital gold. This process makes the Bitcoin ledger immutable and secure. You may have come across doomsday articles predicting that Bitcoin's POW will destroy the world. But in reality, Bitcoin's energy consumption is becoming more efficient over time, and it promotes the development of renewable energy resources. Moreover, Bitcoin's energy consumption is a drop in the ocean compared to the energy consumed by traditional financial systems, military, and political machines. As we progress towards a Kardashev Type 1 energy civilization, Bitcoin mining could accelerate this transition. In conclusion, Bitcoin's energy consumption is well spent. Instead, it's a driving force for innovation, efficiency, and improving our society. So, there you have it, folks. Bitcoin's energy consumption is a game-changer that could help shape our future. If you're passionate about crypto like we are, head to our website, cryptoinvestornewsnetwork.com, for all the latest news and updates. And if you're looking to show off your love for crypto, check out our shop for some awesome crypto merch. Remember, we also have Ledger hardware wallets available for purchase to keep your digital assets safe. All the links are in the description below. Remember to like, comment, share, and follow us on Twitter at CINN. See you in the next video. The era of fluctuating fiat currencies, economic chaos and the search for stability. Crypto Investor News Network. Welcome back to the Crypto Investor News Network. Today, we're discussing Phase 9 of the monetary breakdown of the West, focusing on the era of fluctuating fiat currencies that began in March 1973. Stay tuned until the end to learn more about our website, crypto merchandise, and how to secure your digital assets with a Ledger hardware wallet. Remember to like, comment, share, and follow us on Twitter at CINN. In this era of fluctuating fiat currencies, the world saw the dollar rapidly lose value. In contrast, hard money currencies like the German mark, Swiss franc, and Japanese yen skyrocketed. Though some saw benefits in the short term, long-term problems quickly arose. Currency devaluations, exchange controls, and economic warfare threatened to return as hard money countries sought to protect their exports. As American inflation and dollar depreciation continued, the consequences for the U.S. consumer became increasingly evident. The cost of imports rose, American tourists faced financial difficulties abroad, and the quick sale of cheap exports led to domestic price inflation. The world grew tired of this unstable system and yearned for a return to fixed exchange rates. Unfortunately, the classical gold standard was largely forgotten. The focus shifted to a one-world fiat paper standard the World Reserve Bank issued. While this would eliminate balance of payment crises, it would also provide an open channel for unchecked global inflation. The prospect of runaway inflation loomed large. In the meantime, more immediate goals included a return to a Bretton Woods-like system without gold backing, with central banks working together to coordinate policies and fix exchange rates. The push for a European paper currency and central bank likely succeeded, paving the way for closer global coordination. The future of the dollar and the international monetary system appears grim without a return to the classical gold standard. As we face this uncertainty, cryptocurrencies offer a decentralized, stable alternative to traditional fiat currencies, addressing the challenges faced in the past. Stay informed about the latest cryptocurrency news and developments by visiting our website at cryptoinvestornewsnetwork.com. And before you go, check out our shop for exclusive crypto merchandise and secure your digital assets with a Ledger hardware wallet. Links are in the description below. Don't forget to like, comment, share this video, and follow us on Twitter at CINN Crypto News for the latest updates on cryptocurrency. The collapse of the Smithsonian Agreement and the struggle for monetary stability. Welcome back to the Crypto Investor News Network. In today's video, we'll discuss Phase 8 of the monetary breakdown of the West, focusing on the Smithsonian Agreement and its collapse between December 1971 and February 1973. Stay tuned until the end for information about our website, crypto merchandise, and ledger hardware wallets. Remember to like, comment, share this video, and follow us on Twitter at CINN. The Smithsonian Agreement, once hailed by President Nixon as the greatest monetary agreement in the history of the world, proved to be even more fragile than its predecessors, the gold exchange standard of the 1920s and Bretton Woods. The system was inherently unstable, with fixed exchange rates but no gold or world money to provide currency backing. Several European currencies were undervalued compared to the dollar. The only U.S. concession was a small devaluation of the official dollar rate to $38 an ounce. This move shattered the long-held belief in the permanence of the $35 rate. The agreement needed to be equipped to handle the ongoing inflation, decline of the dollar, and balance of payments deficits. The euro-dollar supply grew, and without gold backing, the free market gold price skyrocketed to $215 an ounce. The overvaluation of the dollar and undervaluation of European and Japanese currencies became increasingly apparent, leading to the dollar's collapse on world markets in February and March 1973. Unable to continue buying dollars to support its overvalued rate, complex money countries like West Germany, Switzerland, and France saw the Smithsonian system crumble in just over a year, exposing the need for a more stable monetary system. The emergence of cryptocurrencies offers a decentralized and stable alternative to traditional fiat currencies, addressing the challenges faced in the past. To stay informed about the latest cryptocurrency news and developments, visit our website at cryptoinvestornewsnetwork.com. Before you go, check out our shop for exclusive crypto merchandise and secure your digital assets with a Ledger hardware wallet. Links are in the description below. Don't forget to like, comment, share this video, and follow us on Twitter at CINN Crypto News for the latest updates on cryptocurrency. The end of Bretton Woods and the era of fiat currencies. Welcome back to the Crypto Investor News Network. In today's video, we'll discuss Phase 7 of the monetary breakdown of the West, covering the end of the Bretton Woods system and the emergence of fluctuating fiat currencies between August and December 1971. Stay tuned until the end for information about our website, crypto merchandise, and ledger hardware wallets. Be sure to like, comment, share this video, and follow us on Twitter at CINN. On August 15, 1971, President Nixon imposed a price-wage freeze to curb inflation and terminated the post-war Bretton Woods system. Faced with the possibility of European central banks redeeming their dollars for gold, Nixon severed the dollar's remaining link to gold, making it a complete fiat currency. This unprecedented move plunged the world into a monetary system reminiscent of the 1930s but with even greater instability, as the dollar was no longer connected to gold. The consequences included the potential for currency blocks, competing devaluations, economic warfare, and the breakdown of international trade and investment, ultimately leading to a global depression. To establish a new international monetary order without a gold link, the U.S. led the world into the Smithsonian Agreement on December 18, 1971. However, this only served as a temporary solution, and the world has continued grappling with the challenges of fiat currencies. The rise of cryptocurrencies offers an alternative to traditional fiat currencies, providing a decentralized and more stable means of exchange. To stay informed on the latest cryptocurrency news and developments, visit our website at cryptoinvestornewsnetwork.com. Before you go, check out our shop for exclusive crypto merchandise and secure your digital assets with a Ledger hardware wallet. Links are in the description below. Don't forget to like, comment, share this video, and follow us on Twitter at CINN Crypto News for the latest updates on cryptocurrency. The unraveling of Bretton Woods, 1968 to 1971, and the rise of cryptocurrencies. Welcome back to the Crypto Investor News Network. In today's video, we'll explore Phase 6 of the monetary breakdown of the West, which covers the unraveling of the Bretton Woods system between 1968 and 1971. Stay tuned until the end for information about our website, crypto merchandise, and ledger hardware wallets. Remember to like, comment, share, and follow us on Twitter at CINN. As dollars accumulated abroad and gold continued to flow outward, the U.S. struggled to maintain the gold price at $35 an ounce in the free gold markets. In March 1968, the U.S. introduced the two-tier gold market to prevent the free gold market from endangering the Bretton Woods arrangement. The idea was to separate government and central bank transactions from private transactions, allowing the latter to fluctuate in the free market. The U.S. also pushed for creating special drawing rights, SDRs, intended to eventually replace gold as a world paper currency. However, SDRs have remained a small supplement to currency reserves due to opposition from hard money countries. Economists predicted that gold would disappear from the international monetary system and its price would fall below $35 an ounce. Contrary to their expectations, the free market gold price steadily rose, reaching around $125 an ounce by early 1973. The two-tier gold market only bought a few years before the Bretton Woods system faced a crisis, as American inflation and deficits persisted. The growing discrepancy between the official and free market gold prices revealed the loss of global confidence in the dollar, ultimately leading to the final dissolution of the Bretton Woods system. The collapse of Bretton Woods and the subsequent rise of cryptocurrencies highlight the importance of decentralized monetary systems in addressing the flaws of traditional systems. To stay updated on the latest cryptocurrency news and developments, visit our website at cryptoinvestornewsnetwork.com. Before you go, check out our shop for exclusive crypto merchandise and secure your digital assets with a Ledger hardware wallet. Links are in the description below. Remember to like, comment, share this video, and follow us on Twitter at CINN Crypto News for the latest updates. Bretton Woods and the Gold Exchange Standard, Inflation and Economic Consequences. Welcome back to the Crypto Investor News Network. In today's video, we'll be delving into Phase 5 of the monetary breakdown of the West, covering the Bretton Woods system and the new gold exchange standard between 1945 and 1968. Stay tuned until the end for information about our website, crypto merchandise, and ledger hardware wallets. Remember to like, comment, share, and follow us on Twitter at CINN. The Bretton Woods system, conceived by the United States in 1944 and ratified in 1945, aimed to create a new international monetary order. Though it functioned better than the chaos of the 1930s, it was ultimately an inflationary extension of the gold exchange standard of the 1920s and was destined to collapse. The US dollar became the primary currency in this new system, replacing the British pound as the key currency. However, only foreign governments and their central banks could redeem dollars in gold, which laid the groundwork for inflation. After World War II, the U.S. held a large gold reserve, enabling the pyramiding of dollar claims on top of gold reserves. Initially, the dollar was undervalued, leading to a so-called dollar shortage and export surplus, with the American taxpayer bearing the burden of foreign aid. The U.S. government embarked on a policy of continuous monetary inflation, eventually leading to a balance of payment deficits with other countries that followed a hard money policy. As the dollar's purchasing power declined, foreign governments became increasingly reluctant to hold dollars, and the gold standard check was put into use. Gold flowed out of the U.S., and European countries began redeeming dollars in gold, which gradually undermined the Bretton Woods system. Despite the mounting problems, the U.S. government continued its inflation policy and benign neglect. However, economic laws eventually caught up with the government, and by the late 1960s, the Bretton Woods system began to unravel. Understanding the consequences of the Bretton Woods system helps us appreciate the potential benefits of decentralized monetary systems like cryptocurrencies. To stay updated on the latest cryptocurrency news and developments, visit our website at cryptoinvestornewsnetwork.com. Before you go, check out our shop for awesome crypto merch and secure your digital assets with a Ledger hardware wallet. Links are in the description below. Remember to like, comment, share this video, and follow us on Twitter at CINN Crypto News for the latest updates. Fiat currencies and monetary chaos, the prelude to World War II. Welcome back to the Crypto Investor News Network. In today's video, we'll explore Phase 4 of the monetary breakdown of the West, focusing on the era of fluctuating fiat currencies between 1931 and 1945. Be sure to wait until the end for information about our website, crypto merchandise, and ledger hardware wallets. Remember to like, comment, share, and follow us on Twitter at CINN. The 1930s marked a period of monetary chaos as the world reverted to the disarray of World War I, with fluctuating exchange rates, competing devaluations, exchange controls, and trade barriers. International economic and monetary warfare intensified, and global trade and investment suffered. In fact, Secretary of State Cordell Hull argued that these financial conflicts were a significant cause of World War II. In 1933–34, the United States abandoned the classical gold standard to escape the Depression. Although American citizens could no longer redeem dollars in gold or own gold, the U.S. maintained a unique gold standard, with the dollar redeemable in gold for foreign governments and central banks. The global economic turmoil led to gold flowing into the United States, one of the relatively safe monetary havens. The chaos of the 1930s highlights the shortcomings of freely fluctuating fiat currencies, a concept advocated by some economists. The problem with this approach is that it grants total control of the money supply to nation-states, and it's naive to expect governments not to abuse this power. The experiences of this era led U.S. authorities to prioritize restoring a stable international monetary order during World War II, hoping to foster a resurgence in global trade and the benefits of an international division of labor. Understanding the pitfalls of fluctuating fiat currencies helps us appreciate the value of decentralized monetary systems like cryptocurrencies. To learn more about cryptocurrency news and developments, visit our website at cryptoinvestornewsnetwork.com. Before you go, check out our shop for awesome crypto merch and secure your digital assets with a Ledger hardware wallet. Links are in the description below. Remember to like, comment, share this video, and follow us on Twitter at CINN Crypto News for the latest updates. The gold exchange standard, a flawed system that set the stage for collapse. Welcome back to the Crypto Investor News Network. In today's video, we'll explore Phase 3 of the monetary breakdown of the West, focusing on the gold exchange standard between Britain and the U.S. from 1926 to 1931. Remember to wait until the end for information about our website, crypto merchandise, and ledger hardware wallets. Be sure to like, comment, share, and follow us on Twitter at CINN. After World War I, nations faced the challenge of restoring their currencies to the gold standard. Instead of adjusting to the new economic realities, Britain returned to gold at its pre-war exchange rate of $4.86 per pound. This decision, driven by national pride and a desire to maintain London's financial dominance, severely affected the British economy. Britain attempted to mitigate these consequences by creating the gold exchange standard at the Genoa Conference of 1922. The new system saw the U.S. remain on the classical gold standard. At the same time, Britain and other Western countries adopted a pseudo-gold standard, redeeming their currencies in large gold bars or critical currencies like the US dollar or the British pound. This allowed these countries to maintain greater paper and bank inflation. The gold exchange standard resulted in a precarious financial structure, with the US dollar and the British pound as crucial currencies and other European currencies linked to the pound. This system enabled unchecked inflation and the accumulation of deficits, undermining the market discipline that the gold standard once provided. The gold exchange standard was inherently unstable and eventually led to a disastrous collapse. In 1931, a loss of confidence in the system and the failure of inflated banks throughout Europe prompted Britain and other European countries to abandon the gold standard completely. Understanding the flaws of the gold exchange standard can help us appreciate the importance of stable and decentralized monetary systems like cryptocurrencies. To learn more about cryptocurrency news and developments, visit our website at cryptoinvestornewsnetwork.com. And before you go, be sure to check out our shop for awesome crypto merch and secure your digital assets with a Ledger hardware wallet. Links are in the description below. Don't forget to like, comment, share this video, and follow us on Twitter at CINN Crypto News for the latest updates. The collapse of the gold standard, World War I and its aftermath. Hello everyone, and welcome back to the Crypto Investor News Network. Today, we're diving into the second phase of the historical monetary breakdown of the West, the impact of World War I and its aftermath on the gold standard. Stay tuned until the end of the video for more information about our website, crypto merch, and how to secure your digital assets with a Ledger hardware wallet. Remember to like, comment, share, and follow us on Twitter at CINN. World War I marked a turning point in the international monetary system, as the classical gold standard broke down due to the financial pressures of the conflict. Governments entrusted with ensuring their currencies remained redeemable in gold failed to keep their promises. As the war intensified, they inflated their currencies to fund their military efforts, ultimately suspending gold convertibility, except for the United States. The result was a chaotic global monetary landscape characterized by fluctuating exchange rates, competitive currency devaluations, exchange controls, tariffs, and quotas. International trade and investment suffered greatly as currencies depreciated in relation to gold and the US dollar. Back then, most people recognized the severity of the situation and the need to return to the stability and freedom of the classical gold standard. Economists and politicians sought ways to restore this system and rebuild the global monetary order. As we continue exploring the history of the world's monetary systems and the rise of cryptocurrencies, it's crucial to understand the impact of events like World War I on the financial landscape. To stay informed on the latest cryptocurrency news and developments, visit our website at cryptoinvestornewsnetwork.com. Before you go, check out our shop for unique crypto merchandise and secure your digital assets with a Ledger hardware wallet. Links are in the description below. And don't forget to like, comment, and share this video, as well as follow us on Twitter at CINN Crypto News for more updates. The Golden Age of the Classical Gold Standard, 9 Phases of Western Monetary Collapse. Hey everyone, welcome back to the Crypto Investor News Network. Today, we're going back to explore the Golden Age of the international monetary system, the classical gold standard era, from 1815 to 1914. Understanding this period is crucial for those interested in the history of money and the origins of today's monetary challenges. And, as always, stick around to the end of the video to learn more about our website and awesome crypto merch. The classical gold standard was when the world's major currencies were directly linked to gold, each representing a specific weight of the precious metal. This allowed exchange rates between currencies to remain fixed, providing stability and facilitating international trade, investment, and travel. Gold was chosen as the monetary standard, not by government mandate but because it had emerged over centuries as the most stable and desirable form of money in the free market. One of the great benefits of the gold standard was its ability to act as a check against government-induced inflation. Under the classical gold standard, the balance of payments between countries was maintained through an automatic market mechanism. If a nation inflated its money supply, it would experience a rise in prices, leading to an increase in imports and a reduction in exports. The resulting balance of payments deficit would force the country to contract its inflated currency to prevent a loss of its gold reserves. Though the classical gold standard was imperfect, it was the foundation for a relatively stable and prosperous global monetary system. Government interventions, such as monopolizing the mint, enacting legal tender laws, creating paper money, and establishing inflationary banking systems, did contribute to some economic fluctuations. However, the market mechanisms under the gold standard kept these disruptions in check. In summary, the classical gold standard era, often called the Golden Age, facilitated global trade, investment, and economic growth. It provided a stable monetary system that prevented significant financial crises and offered a level of stability unparalleled in history. As we continue to navigate the complexities of today's monetary systems and the rise of cryptocurrencies, it's essential to understand the historical context that brought us here. If you'd like to stay informed about the latest cryptocurrency news and developments, head to our website, cryptoinvestornewsnetwork.com. Don't forget to check out our shop for some fantastic crypto merchandise and to secure your digital assets with a Ledger hardware wallet. Links are in the description below. Before you go, please like, comment, share this video, and follow us on Twitter at CINN Crypto News for more updates. Unraveling the 20th Century, 9 Phases of Western Monetary Collapse. Hey everyone, and welcome back to the Crypto Investor News Network. In today's video, we'll dive into the historical breakdown of Western monetary systems by examining the 9 distinct phases of the 20th century. We will explore how government intervention has played a significant role in the ongoing financial crises and consider the potential of cryptocurrencies to reshape the economic landscape. Let's take a look at each of the 9 phases in turn. 1. Phase 1. The classical gold standard, pre-World War I. A period of relative monetary stability, where countries adhered to a gold standard, allowing for stable exchange rates and limited government intervention in the financial system. 2. Phase 2. World War I and the interwar years. This phase saw the abandonment of the gold standard by many countries, leading to rampant inflation and unstable exchange rates as governments financed wartime spending through monetary expansion. 3. Phase 3. The Great Depression and currency devaluations. During the Great Depression, governments worldwide devalued their currencies to spur economic growth, further destabilizing international exchange rates and exacerbating the financial crisis. 4. Phase 4. The Bretton Woods System, 1944 to 1971. Established after World War II, the Bretton Woods system created a new international monetary order based on fixed exchange rates, with the US dollar pegged to gold. However, this system eventually faced mounting pressures and collapsed in 1971. 5. Phase 5. The Nixon shock and the end of the gold standard. In 1971, President Nixon suspended the convertibility of the US dollar to gold, effectively ending the gold standard and ushering in an era of floating exchange rates and rampant inflation. 6. Phase 6. The 1970s oil crisis and stagflation. The oil crisis of the 1970s led to skyrocketing inflation rates and economic stagnation in many Western countries, prompting governments to implement various monetary policies to stabilize their economies. 7. Phase 7. The 1980s and the rise of monetarism. In response to the failures of previous interventions, many governments adopted monetarist policies, focusing on controlling the money supply to combat inflation. While initially successful, these policies also faced their own set of problems. 8. Phase 8. The 1990s and the emergence of the euro. The creation of the euro in the 1990s aimed to create a single, stable currency for the European Union. However, the Eurozone crisis that emerged in the late 2000s exposed the flaws in this monetary union. 9. Phase 9. The 21st century and the rise of cryptocurrencies. The ongoing monetary crises of the 21st century have led many to seek alternatives to traditional financial systems. Cryptocurrencies, with their decentralized nature and secure means of exchange, have emerged as potential solutions to the cycle of intervention and crisis. As we can see, the 20th century was characterized by a series of government interventions that ultimately led to the instability and collapse of Western monetary systems. In this context, cryptocurrencies hold the key to breaking this cycle and ushering in a new era of financial stability. If you're interested in learning more about cryptocurrency and staying up to date with the latest news and developments, visit our website, cryptoinvestornewsnetwork.com. And remember to check out our shop for some awesome crypto merch. If you want to secure your digital assets, consider purchasing a Ledger hardware wallet. The links are in the description below. Before you go, Please like, comment, and share this video, and follow us on Twitter.